What do we got? Identifying a strangle. Okay, I'm going to show you now how to identify a strangle using technical analysis. Now, this is exactly the charts that I look at when I'm doing this strategy. I have pretty much a blank chart with no lines on it or anything because you don't want to get too busy. You'll draw all those in after. But what we're looking at first is the Bollinger Bands. Now you can see the Bollinger Bands. Typically they're a indicator of volatility. When they're wide apart like this, volatility is rising or volatility is high. But when they're close together like they are here, and especially like they are here, the volatility is quite low, and this is an ideal time to enter a strangle. As long as everything else stacks up as well. Now, and you can see the stock's in consolidation. So normally when the stock is in consolidation, volatility is low, and there's going to be a breakout in either direction or in one direction. So you know that. I also had the C stats on just to see whether there's any divergence, which there is. You can see there's quite big bearish divergence. This is the stock price is rising while the stochastics are falling. So that's going to tell me something's going to happen. And this is a new indicator, ATR. The ATR is the average true range. I learnt this off my broker, who is fantastic, who's taught me a lot about this strategy actually, because I used to trade this strategy on its own quite a while ago, and never could really make it work. But the reason why I couldn't make it work is because I didn't know all these little tips and tricks that I'm sharing with you today. So it helps to talk to someone. It helps to ask for help. If you need help, you got to ask for it. And it helps to just go, okay, so tell me more about this. And when I said, okay, well, tell me more about it, I've found a wealth of knowledge, and not all brokers are the same either. My previous broker had no idea that this is what, didn't do it like this at all, and it's why I didn't keep doing it, was because, they didn't give me the good goss like my current one's doing. So anyway, the average true range indicator is a true range indicator of volatility. And any charting package should have it. Any good charting package should have it, because mine does. And it's a pretty standard charting package. But and the ATR measures your volatility over the last however many days you put into it. Say you want to measure the volatility over the last 30 days. So what you're looking for is a true range of where the stock could possibly go. So you want to know that if your break-evens are here and here, that the stock is going to be able to hit those break-evens with quite easily. So you get a figure of the average true range, and then what you do is you want to make sure that your entry price is no more than, I say, 2.5 times the average true range, because you want to make sure that your stock is going to be able to move and be able to hit those break-even points. And if your entry price is too high, you just don't do it, because the volatility is obviously, either it's too high or the stock just hasn't got a hope of, it's just a too expensive strangle, hasn't got a hope of hitting those prices. And you want to make sure too that your ATR is quite low. You can see here volatility is quite high, and it comes all the way down. Your ATR's here, so that's pretty good. Okay. So I'll have a look at some more technical analysis using patterns. Now, I use a lot of patterns in my trading, and especially with doing this kind of trade, because with any kind of pattern like a flag or a pennant, it's like a consolidation pattern, a mini consolidation pattern. And what happens in this process is that the volatility, or the Bollinger Bands, also usually come in. As you can see, as this pattern's been unfolding, the Bollinger Bands have been squeezing in, which is an ideal, time to get in. And any kind of pattern like this too, you can get a indication of where the stock's going to go too, because you can measure from where the stock was. Up here, you measure to, like you do your lines like a flag, and then you're up to where the recent high, and then you can re-measure the same. You get the same distance, and hits it there, and you can see that that's a very valid point, because there's a lot of resistance there, and then it became support around that. So you got to think to yourself, well, is it going to be support, or is the stock going to, run off it? But anyway, this when you're trading the Strangle, this all wouldn't be here. You'd be you get your projection and you'd think, okay, well, you'd be up here and thinking, does this look like a good trade? You look down to the stochastics around the same time and they're neutral, so it could go somewhere. And so with the RSI is neutral, so it could go either direction, up or down. And that's the ideal time for me to enter a Strangle. And as you can see, what happened is if you had entered up here, it would have been a great Strangle to get in down. You would have made quite a bit of profit on the downside here. And you had you've had a target where it was going to go. So you could close out there or enter another Strangle here and just see if it kept going or if it then broke up to the upside. So great patterns. We'll just have a look at another pattern here, a double top. A double top's also good for Strangles, because as you can see, as the second top is forming, the Bollinger Bands are coming in and squeezing in, and you look at that. Now a double top is a bearish pattern. You draw the neckline in, you measure from the top, and then you project it down, and you get another target. And as you can see, it's pretty spot on where it's been support before. It could also be support again in the future, and it looks like it sort of is around that sort of area. And you also can see from those two tops, look at the bearish divergence on the stochastics and the RSI, and also your ATRs down here, which you can see is falling, and that's what you'd want to see, being that the volatility is low. So they're both good entry points, and there's plenty of other patterns too. And I encourage you if you want to learn more about technical analysis patterns, I put together a whole video package on technical patterns, bullish and bearish technical patterns, and how to identify them, and work with workbooks and audio. Lots and lots of great information in there. And if you'd like to get yourself a copy of that, you just go to my website. You'll find that the Mum's the Word video series volume 2 and 3 is there, and also my blog on the right hand side of my trading diary blog is where you can get yourself a copy. Now, I've also, as in my last strategy tutorial, I made a worksheet, and I've done the same here, because it's just so easy to be able to plug some figures in and see at a glance whether this is going to be a profitable trade or not. So, for my valid members and subscribers and things like that, I always try and give you the best. So this is a really easy little spreadsheet to plug the figures in. As per the other one, all the green you plug in, and this one down here. So it's basically you just put in the code, you put in the stock price. You don't need to put in the date goes in there automatically. You put in the shares per contract, the number of contracts you want to do, your put strike, the put cost, the expiry, the call strike, call cost and expiry, and the spreadsheet will work out how many days you got to go. It'll work out your total cost, less your not including brokerage, of course. It gives you your strategy enter price, which is here, which is vital, because you need to know how much it's going to cost you to get in. It also gives you your upper break-evens and your lower break-even point. So you can just go straight to the chart and then work it out on the chart and see whether it's going to be a profitable trade or not. Now, here's the ATR over here. Now, you would be able to find out what the ATR is by looking at the indicator on the chart. Like, it should tell you what figure is in there. So in this instance it was 32, so I just plugged 32 in there, and then you come over to here and it works out what your 2.5 times is. So you should not enter the strategy if the entry price is over 80 cents, which you can see it's not. So you think, hey, this could be a good trade. So that's pretty good for me. Now I'll show you then on the next page will be the chart and where the break evens are. I'll put those on. This is what I suggest you do. These are the steps I suggest you take. You fill in this sheet just as when you're trying to work out whether it's going to be a good trade or not.